Hi everyone, it's Mike from Order Flows and welcome to the Order Flow Dynamics course, module number 8 on trading the stop hunt. We've all felt that sometimes, people are out there specifically looking for our stops and triggering them right before the market reverses. But you know what? Honestly, nothing could be further from the truth. And a lot of the time, stop hunts and stop runs, what we think are stop hunts and stop runs, are often false breakouts in disguise. Right? There are always going to be traders out there who, quote, hunt for stops, right? What they're doing is looking for areas where they expect a lot of stops to be sitting that, if triggered, will cause continued buying or selling in that particular direction. Traders who hunt for stops are predatory in nature, and they are generally not looking for the move to continue all day long. They want to trigger stops, scalp a few quick ticks, and move on. And, on a normal bar chart, oftentimes you see big wicks and candles, right, coming in at a certain area. This 1810 area, was a previous resistance area, which turned into support, and the market broke through there and spiked down a quick $10 and came right back up. That's what a stop run looks like, right? And if you look on a footprint chart, this is what it looks like. It's basically this massive selling imbalance, stacked massive selling imbalance all the way down. Okay, and people say, well, there's some offers here. Well, you know what? Lots of times when big orders get entered, they don't get entered stop market. They put a stop limit on it, right? So that's why you see, 1810 down to 1807.5. It's a $2.50 limit. That's why you see some size here being traded on the offer: 173, 63, 157, 49. Now, granted, this is a delta footprint chart. It's not a normal volume footprint chart, so it's looking at the difference at each price level. So obviously there was more traded on the offer at these 4 price levels here, but this area right here, this is very indicative of a stop being triggered around this 1810 area, as we just cascade into more stops, more stops, more stops. Turns at offer, more stops get triggered. So where stop hunts get interesting and useful for order flow traders is what happens after the stop gets triggered. I see people talking about stop hunts like thinking they're going to participate in the hunting. No, you got to react. By the time you get your order in, the move is already over, okay? But you can still take advantage of it by watching the subsequent order flow, as the stop hunts are often short-lived and offer some pretty good to great trading opportunities in the opposite direction. So the duration of a stop run is very short, and in reality, you are not going to capitalize on the stop run itself. You got to capitalize on the resultant order flow that happens afterwards. And remember, markets are always performing price discovery. Stop runs are a form of price discovery, and prices are rejecting the new levels. So instead of going with the momentum of the stop run, you're going to be fading the momentum because the market is out of balance. And when a market is out of balance, that's where the opportunity arises. So just very briefly to, get a better understanding of a stop run and stop hunts is, traders like to do that because they want to jumpstart a move sometimes, right? If the market is coming into a support or resistance level and they feel there's stops there, they feel they can just trigger it, then more selling or more buying will follow afterwards. Now, traders who get stopped out in obvious areas will claim their stop got picked off. I admit, myself, I put stops in the market every time I put an order in. I also have a stop that follows it. And there are times where the market literally trades right down to my level, triggers my stop. I'm filled at the low of the move, market reverses back up. And the newer traders will say, oh, they picked off my stop. The broker knew where my stop was. No, it's just bad stop placement. Okay. And you just got to live with it. Unfortunately, that's what happens sometimes in the market. So what exactly is a stop hunt? Well, it's an astute trader is going to look for areas in the market where traders are likely to place stops. They're not going to just go stop hunting without, having knowledge of, is this an area that I think a lot of traders could have stops in? Okay, so that's the area that they're going to try and trigger the stops. Not just every single price level they're trying to trigger stops, but for the stop run to be successful, it needs to be an area that a lot of traders are going to be hiding around. Okay, when I mean hiding around, I mean placing their stops. And you know, the thing is, right, and I talked about vertical moves earlier, right, and I said volume stops vertical moves. Well, volume also stops, prevents, or not prevents, but ends stop runs, or basically knocks them out. Okay, so here we're coming up into new highs. There's people triggering stops. Anytime you come up near a new high, people are always going to want to try and trigger stops. But then you get up here and there's volume, right? There's volume stopping the stop run. Okay, you can see the 420, the 241. Then you see legitimate buying coming in behind it, because the market turns bid, it turns bid. But right here, this aggressive buying, this 24 against 5, the 2 against 72, this probably started out as a stop run, but it ran into volume up there. If there was no volume, it probably could have spiked up and then just sort of then started rotating around. Now, there are different types of traders who try to trigger stops. Okay, you're going to have the scalper. It's someone who's looking for a quick score. When these guys trigger stops, the market often reverts back to its pre-stop level. And not every time they trigger stops, it works out. Sometimes they try to trigger a stop, and there's no stops there. What happens? They got to cover their trade, 3-4 ticks away from where they sold it at, and for a loser. So not always does it work. Now the size trader is different, right? The size trader, the big institutional trader, knows he may trigger stops and wants to get on as much as possible before he does, because when this guy triggers stops, the market often continues in that direction, because not only has he just triggered a stop or stops, but he's also buying. So he's going to end up working against him. So he has to sort of work around that. And in most markets that we trade, it's pretty liquid, right? E-minis, crude oil, bonds. But you get into some of the soft commodities, for example, cotton. You start triggering stops, and the market can move pretty quickly, because there's not necessarily a lot of volume that these stops that are being triggered are looking for. And next thing you know, market could go limit bid or limit offer in the next minute or so, because not only are you triggering stops, making the market move higher or lower, but then people also see the market's moving higher or lower, then they get in and they start buying, and markets. So some of these markets trade slightly different than others, but in most, you don't really have to worry about markets going limit up, limit down in the very liquid markets. There tends to be enough volume to prevent that. But in some of the lesser markets, I'll say lesser markets, but some of the markets that are not as liquid as, say the E-minis, well, there's no market as liquid as the E-minis, but some of these markets that just don't have that big participation from retail investors, as well as institutional and commercial investors. So like things like softs, when people hunt for stops there, it can be pretty nasty. But generally, most retail traders don't trade those markets, so it's not that big a deal. So how do you tell the difference between when a scalper is trying to trigger a stop or a size trader is trying to trigger a stop? Is you watch the size trading after a level where stops are going to be placed. If legitimate size trades after the potential stop level, okay, the chances are there is more to the move. If there's no follow-through activity in the order flow, you fade the move, and you can see that pretty quickly. And you don't have to have like automatic reflexes to take advantage of it. It will work itself out over the next minute or so. So if there's no follow-through activity in the order flow, fade the move. It's going to revert back to its pre-stop level. Okay, up here, we probably triggered a stop, ran into some size. Then up here, once you get past 16.5, it looks like it triggered a stop higher. Okay, where's the follow-through buying? There was none. Immediately came back in here, right? And then just sort of went sideways. Eventually, it did tick back up to the high and came off again. No follow-through. All right. In this case, market selling off. Boom, triggers a stop 39.50. Only trades down to 39.47. So it's like 100 lots right here. Probably the big order is by about 100. There's probably another stop in there for about 20 or so, and it only moves 4 cents Okay, then the market snaps right back. And so I talk about fading the move. You know, the first one, yeah, if you faded it, it just sort of went sideways over the next couple of bars, did trade back up before coming off. This one, you fade it, it continues up there because there's no follow through, right? It was a stop that got triggered, but it didn't really move that much. It just moved 4 ticks, then came back up. Okay, you know, it's, in my opinion, it's a pretty safe buy. You could be buying it, you know, somewhere around this 39.54, 55 area. You know, your stop is where? Right below, you know, right around the area where the stop was earlier. Because, you know, when you triggered those stops, there was no more selling. You know, people weren't interested in continued selling there. Now here's one where you got follow through, right? You know, this one, I don't know if there was a stop there. It's hard to tell. Down here, I think it's a little bit more obvious. The 31.10 area, you stop the triggers, and then it keeps making a new low here. You could sell that, okay? And it moves lower another 3 or 4 points, okay, before reverting back. First time we hit the low, okay, we traded this low a couple times here. This time at 724, we traded one lot, rally back up, then start coming back in, and they're trying to get it through this 112.96 level. They finally get it past there. You know, and do they trigger some stops? You know, is the selling, you know, this one's debatable, right? Because I like to see imbalances, stacked imbalances, and I don't like to see necessarily a lot of counter trend here. You got 72, so you know this one is probably an aggressive seller, but again, we don't revert back, right? The follow through order flow is there to continue this move down. So again, watch that follow through order flow. If it's there, like here, go with it. If it's not there in the next bar or by the time this bar closes, fade it, right? What's the difference? This bar closes on its low. This bar closes in the middle, right? That's weak. This one is strong. Close on our low. The next bar, more often than not, will keep going lower. Now, stop hunts triggering, you know, that whole mechanism. Look for them around support and resistance levels. Look for them around the highs and lows of the day. Look for them around swing highs, swing lows, although, you know, it's probably better around swing highs, swing lows, around the highs of the day, lows of the day, you know, as well as go back into yesterday's high and low as well. Keep a mark on your chart of where yesterday's high and low. You know, I know NinjaTrader has a function that you can put the previous day's high and low on your current day's chart, you know, because those are significant levels for a lot of traders. And, you know, it may not matter anything to you in your analysis, but if you're looking for areas where potential stops could be placed, yesterday's high, yesterday's low is a good place, and a lot of traders do use those levels. So again, it's not about how you trade, it's about how a lot of other people trade. Okay, so like I said, you may not use yesterday's highs or lows in your analysis, but a lot of traders do, and a lot of traders put stops around those levels, so keep those in mind. Now watch the reverse, okay? What I talk about when I mean the reverse is if you trigger a stop and you immediately come off of it. Okay, that's what I mean by the reverse. Market pops and market drops. Break the high or low by 1 or 2 tick. Traders are looking to trigger those stops. You know, they're trying to break the high or the low. They got to push it down a tick, sometimes 2 ticks. If there's nothing there, oftentimes you see the reverse pretty quickly. Okay, because the stop triggering failed, right? And there was no breakout, right? And that's why you got to realize, you know, a lot of times it's people trying to trade, you know, trying to get a breakout started by triggering stops. Now, if there's heavy volume, okay, for example, a prominent point of control, or a high or low by a tick, or 2, but no follow through, you know, or an unfinished auction, you know, these are all signs of failed stop hunts. Okay. Now, in the sense of failed stop hunt, getting past a level of heavy volume by a tick or 2 and you can't carry on, what does that tell you, right? There's just no interest there, right? You got unfinished auction, what does that tell you? There's no finish there. There's no follow through there. Now, if there's size at a level, the stop hunt will fail, right? Just like a vertical move, right? Stop hunts are people trying to trigger a vertical move. And what stops a vertical move is size, is volume. Okay, here's a stop hunt being triggered, right? We just sort of go sideways. But even down here at 114 even, there's size, right? You have an unfinished auction down here. Okay, what happens? The market reverses from there. Now, a stop hunt at the high and previous day's high. This green line is today's high. This blue line is the previous day's high. Now, this is something you got to keep in mind, right? When you have highs, like day's high along with the previous day's high, and sometimes even the previous day's high, sort of all around the same level, you got to be watching. You know, a lot of people are going to be placing stops there looking for a breakout. Okay, and it happens here. You know, this, you're only talking, you know, what is that, 870 to 877 is the difference between these two highs, today's high and the previous day's high. So you could bet your bottom dollar that people are going to be trying triggering this, get it to go higher, and they do, right? This one works, right? This one, boom, takes off, and it just takes off to the moon. Here's a stop hunt. It reverted back, and then it just sort of ground up, okay? Then another stop hunt here at this new high. Again, no, this time he had no follow through, right? And then you just go inside, 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 right? But when you see something like this, right, this is a big push to get the market to go up, and it does. But then where's the follow through buying? There is none, right? In this case, we sort of just ground our way higher. I still would have short this. I like highs like this are great shorting opportunities, but you know, if you short it, then you know, market starts ticking higher, that's your sign to get out. If you short it, you want to start seeing it fall over. Like here, market shot up, you get short, you know, then it comes down, next bar opens up, you get short. Yeah, okay, this one worked out a bit better than what had happened earlier. You know, that's why I talk about, you know, follow through. Stop hunts occur around round numbers as well, right? 25,900. You know, now this was within the day's range, or this was at 4 in the morning a couple weeks ago, but still 900 is a level. It's a significant psychological level, and it triggered a stop here. Market reverted back. Okay, then again triggered some more. It came back down, and there's more selling here and moved it lower. Here's a nice stop hunt that bounced back. Okay. Boom, triggered some stops down here on the 857, 858 area. Boom, big order got filled, you know, maybe about 100 contracts, and then the market snapped back. There was no follow through buying. So even though there's a stop hunt here, you know, you notice in the next bar you open up much higher, you're not gonna get shorted, right? You're gonna be looking to get long and, you know, ride it up as much as you can. Okay, so here, stop hunt or stop hunted. Yeah, this in here coming down around the 700 area, you know, people are looking for stops to get triggered, but the market bounces back. We even open up here and we rally all the way. You know, the 20 ticks back up, then they push it back down into that area. Finally, get past it. Then it sells off. 25,661 was the previous day's low. This red line that's coming down is the day's low. So you gotta watch when we making today's low going into yesterday's low, because there's often stops there. Then you see the volume in here, and it's able to get past this volume, and more importantly, close below this heavy volume, right? At the 660, 661, 559, 558 level. You know, you've got what, almost 200 here, 110 here, 100 here, 50 there. You know, that's what, close to 400 contracts right in here. But we get past that level. So even though stops, you know, when people trigger stops, they want to trigger stops in an area where there's not going to be volume, because you're going to get the bigger move. But if you trigger stops into an area where there's a lot of volume, then you got to get through that volume. But if you get through that volume, watch out below, or to the upside, watch out above. Think of structure, okay? If this was interesting, because this was in the mini Dow last week or two, we're above yesterday's high. And we're coming down into yesterday's high. Okay, now this gets tricky for a lot of people because, one, there's probably going to be stops there around yesterday's high because you've been spending all day above it, but at the same time there's also going to be support there, right? Because people are looking for the market probably to come down into the yesterday's high and then bounce up off of it. Okay, so you got to be watching what's happening in the order flow. So you sort of have two schools of thought. People that are looking for stops to get triggered there, because again, we've been above yesterday's high all day long. We're getting into the last hour of trading. So everybody that's been long since yesterday, well, if we come into yesterday's high, I want to be out. But then you also have the people thinking, well, we've been above, that's my place to buy more. Okay, so you got to weigh it, but more importantly, watch what the volume is going to be doing. Okay, and where we're going to be closing that bar, below the volume, or are we going to trade into the volume and then rally off of it? Here we traded into that volume, sold off, we closed on our low. Next bar we opened up, traded back up towards that area, and then rejected it. At that point, that's your sign to get short. We even put in a nice small print, 3 contracts right there at just 1 tick above the previous day's high, where you can see that's a sign of market rejection. Now, often what characterizes a stop run that has run its course is a stacked imbalance at the end of the bar, okay? And then the bar closes opposite of it. Now, it doesn't have to always close opposite of it, but if you're sort of left with this dangling imbalance out there, that's usually a sign of a stop run. So if you take the stacked imbalance by itself, that would be a losing trade. And what do I mean? Okay, down here, right, you have this stacked selling imbalance. You say, well, it's got stacked selling imbalance, I gotta get short. Well, you're just taking the stacked imbalance by itself. You're not taking into account what else is happening in the bar. Okay, now you traded down, triggered a stop, market rallied back up. Okay, that's not a good sign. Okay, we rallied back all the way back up to the low of the day. Okay, then the next bar we open up and immediately come off of about 4 ticks, but then start rallying. At that point, that's a sign that this area down here is being rejected, right? And then it works its way back up. Now, this stack buying imbalance, I would not characterize that as a stop run or a stop hunt. To me, it's probably just a big order going through the market. Maybe people that sold down here just like, screw it, get me out, because they think the market's going back up. But this one I would not characterize as a stop hunt. This one definitely. We were just trading here 10 minutes ago. Down here, this is fresh territory, virgin territory, so to speak. Okay, so sometimes traders will complain that their stops get picked off by a stop hunter when really all they had was bad stop placement, right? A bad stop placement is often due to not understanding market rotations, right? Remember, module 6 was on market rotations, and often the stop is placed within a rotation, so the chances of the stop getting elected is pretty high. So once you understand the rotations of the market, placing your stops just outside the rotation, can help you out, can keep you in the market a little bit longer. Now, the thing with stop hunts is it's easier to do in thinner traded markets, things like YM, NQ, 6E, than in more liquid markets like ES and CL. When it's done intentionally, the trader trying to do it has to be able to move the market to a level to trigger stops without running into much size. And what I mean by that is, when market's coming into a level, right, even though they're going to be looking at trigger stops around support and resistance, they also got to be looking at the depth of the market. Okay, is there a lot in the order book? Now, what that means is, if you're looking at the order book and you see 2 contracts, 3, 4, 8, 6, 4, 5, not a lot in the depth of the market, yeah, it's probably easier to trigger a stop because, if there's stops there, hopefully it could run through those thin bids. If you're looking at a depth of market that's got, 50, 120, 80, 300, triggering a stop is just, you trigger it's going to go 1 or 2 ticks, right? You want to trigger it at a time when there's not a lot of resting liquidity in the order book. So this concludes Module 8. In Module 9, we're going to finally discuss the order flow trade setups. So I'll see you guys on Module 9. Bye-bye.